Counting equation and Excel. Financial statements after adjusting entries have been entered. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation using Excel. Here we are in Excel. First, a word from our sponsor. Yeah, actually, we're sponsoring ourselves on this one because apparently the merchandisers, they don't want to be seen with us. But that's okay, whatever. Because our merchandise is better than their stupid stuff anyways. Like our Accounting Rocks product line. If you're not crunching chords using Excel, you're doing it wrong. A must-have product. Because the fact, as everyone knows, of accounting being one of the highest forms of artistic expression means accountants have a requirement, the obligation, a duty to share the tools necessary to properly channel the creative muse. And the muse, she rarely speaks more clearly than through the beautiful symmetry of spreadsheets. So get the shirt, because the creative muse, she could use a new pair of shoes. If you would like a commercial-free experience, consider subscribing to our website at accountinginstruction.com or accountinginstruction.thinkific.com. So if you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you could begin back there or just construct your own worksheet as we go, or possibly just follow along with good old paper and pencil. If you do have access to this workbook, though, 5 tabs down below, example, in essence, the answer key, month 1, first month of operations, month 2, second month of operations, practice tab, having pre-formatted cells so you can practice the practice problem with less Excel formatting. The ADJ tab, the one that we will be working in, is the one where we started with a blank worksheet but are basically working within a template now. However, we will be adding to that template as needed as we go, practicing our Excel tools and formatting as we do so. Let's go to the example tab to get an idea of what we will be doing. Remembering we're basically building our bookkeeping system using the accounting equation as, in essence, our trial balance from which we will construct our major financial statements as we're doing this time, that being the balance sheet, income statement, statement of equity. We've entered the first month of data input, closed it out, then entered the second month of data input, and then we put together our adjusting worksheet, remembering that we want to keep separate in our mind what's done on the bookkeeping and accounting side. It have different objectives than what is done on the, we could say, public accounting or adjusting entry side, which is primarily geared towards getting the financial statements as close to whatever accounting basis we are using, typically accrual or possibly a cash basis, so that we can do whatever we need to do, such as external reporting, possibly for investors, for stockholders possibly, or for a loan, the bank possibly, and for tax preparation if you're in the United States. So that's what we're working on here. Oftentimes, I will still take the information out of the accounting software, such as a QuickBooks or a Xero, put it into an Excel worksheet, usually using debits and credits, but in this case, using the accounting equation, so that I have a more transparent view of the impacts of my transactions in the worksheet, which is great when you only have a few of them, not needing a full general ledger then, because you can just have a few transactions that you see within the worksheet. So, and then once we do that, we always want to keep in mind, how are we going to enter this back into the accounting system if we're going to enter it back into the accounting system, so that it doesn't mess up the bookkeeping's current system, which has a different objective, which is to make everybody happy in terms of who they're dealing with, customers, vendors, employees, and to automate things, making the accounting process as unintrusive as possible on the other items of business to keep the business in business. All right, so we're going to now say we finished our adjusting entries. We're going to create our financial statements. Now, in practice, you might take the adjusting entries and maybe enter them into the software like a QuickBooks or a Xero, making sure that it ties out to what we have in our system, and possibly use the software to create the financial statements and then do the adjusting entries. Oftentimes, if you're in like larger businesses, for example, and you're doing public accounting, you're typically going to construct your financial statements, however, somewhere else, possibly using Excel and Word combination or other software, so that you can further group the accounts as needed and make any kind of notes and whatnot that you would have to put into it. So your other option is creating the financial statements outside of the system, and then still entering the adjusting entries possibly into the system and reversing entries, so that everything ties out and is on the same page going forward to the following year, for example. So we're going to do it over here on Excel so we can see what is happening. So we're going to go to the right. By the way, some of the issues, if you put this back into the QuickBooks or something like that, then sometimes the sub accounts don't line up perfectly. They have accounts such as undeposited funds, which doesn't often group together with cash. There's a couple, and often the equity section is a little wonky for certain types of businesses, such as a partnership or in some cases a corporation, because they put that net income in there. Those are just a few things that formatting wise aren't really ideal for generally accepted accounting presentation purposes for the financial statements. So that means the QuickBooks can give you pretty good financial statements, but if you really want to touch them up, and also if you want to tie them together with other reports like notes to the financial statements, you might export them and construct the financial statements outside of QuickBooks. Just depends on what you're doing. But in any case, here are the financial statements. We're going to pull over our information once again. We've done the financial statements a few times, but we've added a few more accounts. We now have the fixed assets broken out, and we have the loan payable broken out between short-term and long-term, and we've done some adjusting entries for adjusting entries. So we're going to just construct our financial statements again based on that information, possibly talking about some of the differences that took place in the adjusting process, possibly also touching on the difference between constructing the financial statements here than what you might do if you just automatically create them in software like a QuickBooks or a Xero. Let's go to the adjusting tab to do this. So what I'm going to do is all the way to the right, we already have our financial statements over here. So where are they? Donde. But now I don't have them at the end. I like to put them at the end so I have room. So now I did all this other stuff in the middle, the bank reconciliation. So what I want to do, I want to pull these financial statements so they're at the end. So what I'm going to do is I'm going to highlight, I'm going to select from where I have the financials in FB column, and then go over to the FS column, right click, I'm going to cut them, not copy them, but cut them, removing them entirely. I took the scissors to them and cut them out. And then I'm going to put that right here, let's say right there, or boom, Control V or paste. And so there we have it. Now I didn't add the skinny. Let's insert a skinny. I'm going to put my cursor on HS, right click, insert, and then I'm going to unformat it, or let's just unformat, clear formatting, and then I'll make a skinny. Selecting the skinny, home tab, font group, clipboard, paintbrush, and make a skinny. Okay, let's go back to the left. I'm gonna now I've got this big blank spot, so I'm gonna close that up, going from FA over to FS. Right click and delete those so that we have a nice, our worksheet is tightened up here. All right, so now what I want to do is pull over my information that's in a horizontal format from the accounting equation and put it back on top of this one, so that we can then adjust our balance sheet according to the new numbers. So what I'm going to do is I'm going to hide all this stuff first, hide all this stuff, and bring over my numbers, put them in a format that I could work with. So I'm going to hide this stuff, hide, and then I'm going to unfreeze the panes, view tab, freeze panes, unfreeze, so that I don't have to deal with that thing. Go all the way to the left, and I'll scroll up to the top. I want to pick up my account names, which is cash, all the way through the interest. And then I'm at the same time, I'm going to scroll down. I'm not holding down Control yet. I'm scrolling down to the bottom, and now I'm holding down control so I can select this one, and now I'm selecting two non-adjacent or not next to each other sets of cells. So I'm going to select these items. So now I'm letting go of control. If I scroll up, now I've got this bit highlighted and this bit highlighted at the same time, or selected. I'm going to right click on it and copy it. Copy that. And then I'll scroll all the way to the right again, all the way to the right. And then I'm going to put that up top, pasting it. Let's put it in the HU, the huh. And then we're going to say, paste it 1, 2, 3, just the values only. Huh. There it is in the huh column. And then we're going to take all this stuff and convert it to a horizontal formatting. So I'm going to just copy that, right click and copy. I'll put it down here, right click, but paste it special pasting, and I'm going to transpose. Boom. And so there they are transposed. And then I'm going to select all of these numbers and transpose them. Copy, right click, paste special, transpose, boom. All right, then I can delete all this stuff. You're no longer needed. You have served your purpose. You have no more use for me, and therefore you will be deleted. This is like the Game of Thrones financial reporting. They've been deleted. All right, I don't need to be. Let's lighten it up here. Lighten it up, okay? This is not. No one needs to be deleted. Like fun group. We're gonna say that we're gonna make this green for the color formatting, and we'll make this one dark red for the liabilities, dark red and white, and then this one's gonna be light red and black for contrast. All right. And then the owner's equity draws down to here's is the equity. Make that dark blue and white. And then I'll make this one the lighter blue and white. Lighter blue, maybe this blue, and white. And then let's make these black and white for contrasting, for formatting's sake, for contrast. And then we'll put some borders around this bad doggy. And we're got to put the borders around the bad doggies, because then if you don't, then they go outside the borders. Like, I told you not to go outside the border, bad doggy. We had to put the borders up. Okay, so now we're gonna copy this over. So I'm just gonna drag it over. I'm gonna drag it over. Boom, boom, put it on top. It's going to delete these. It's going to say there's already stuff there. And I'm like, I know what I'm doing, Wyatt. We're going to undo that. And then I'm going to go, let's go from the HB to HS, right click and unhide. So now we've got our formattings all in there, but now we've deleted all of the numbers, and I'm just going to reorientate the numbers. So let's do this fairly quickly. We've seen it before. I'm just going to do it fairly fast. We've got the current assets, cash. Let's pull that bad doggy down. Pull the bad doggy down. And then I'm going to say this is going to be equal to the number. Pull down the fill handle, copying it down. All right, now obviously we have zeros here. This zero I probably wouldn't want in the financial statement. So for grouping purposes, note that what I would typically do is group these together for external reporting, calling it cash and cash equivalents. But in the QuickBooks file or in Xero or something like that, I need a separate account for each cash or checking account because I have a separate subledger for it. Now note, if you're using like a QuickBooks or a Xero, you might be able to use special formatting, QuickBooks using sub-accounts to allow us to collapse multiple cash accounts. Xero actually being more complex, giving you more flexibility to, as far as I can tell, which is cool, but also a little bit more complex. But notice if you're using QuickBooks sub-accounts, you can't really group the undeposited funds into cash. even though it's basically cash because there's different account types. That's one of the problems that's going to happen in a QuickBooks. Now, there might not be anything in it because it's a clearing account, but if there is, then that becomes a problem. Also note that most software allows us to print the ones out that have a 0 in it and the ones that do not. So even if QuickBooks had a 0 in there, we could just say don't print the ones with zeros in them, and that might be something that's doable as well. So then we've got, okay, accounts receivable, inventory, prepaid, short-term investments, which again, we could eliminate. We probably should, but I'm just going to keep it all of the accounts here that we've been dealing with just so you can see them pulling in where they would be located on the financial. I'll do an underline here. Let's go to the PP&E, property, plant, and equipment, depreciable assets, where we've structured it now in the format of having the format tying out to what is on the subledger. So now I've got furniture and fixture, and then I've got the accumulated depreciation related to it. So this is the cost. This is how much has been depreciated over the entire life thus far. And I'm going to put it in the financials as a positive. Notice that if you're formatting this, sometimes people like to put less or minus, right? Less this amount. So you don't put a negative number oftentimes in the financials. You could, sometimes you'll see that. So, but you might put less in the words telling them the operation, not with signs, but with words. I put the difference between the two, which is the book value on the right. And then I'm going to say, all right, let's do the machinery and equipment and the ACC depreciation related to that, noting I abbreviated the accumulated depreciation because accumulated is really long. Why do we have to use such long words? Because it confuses people, and we're trying to get paid here. I don't know why they have to use long words. I think that's part of it. It's lawyer language. They use long words to confuse you because they can bill more that way. Anyways, you got the 5,000 minus the 139 is going to give you the book value, the 4861. Noting we got to be careful of those negative numbers. Those are contra asset accounts, and they often are the problem when you're out of balance because you often make these go the wrong way when you pull them into the financials. So this is going to be the sum of those two. That means this is our total property, plant, and equipment, and the total assets is this plus this. We can check those subtotals. I can check the whole thing by selecting all these numbers. 226, 784, is that what it is? Yeah, I think I got it. My eyes are going here. And then I can check, if that wasn't correct, I can check this one, 133, 757, boom, boom, looks good. And then these I can check easily because I don't have two columns, but one column with the positives and negatives, or if they were debits and credits, I would still make the credits negative, so I can just highlight them and say 93027 looks good. MUI B to the N. Let's move on to the liability side. On the liabilities, we got the AP, the accounts payable. It's at the 4008, and then I'll copy this down. Now note that here we've got credit card. This is also another account that's possibly common in like a QuickBooks or when you're doing the bookkeeping, but on the financials, you're probably going to want to call it like credit card payable or something like that, which you can do using accounting software using something like the sub accounts, making a master account called credit cards payable or something, credit card liability, and then making sub accounts to it so that you have both the detail and can collapse it for financial reporting. So that's good. Payroll taxes, let's put an underline. Well, wait a sec, is that all we got? We've got interest and then two loans. Let's copy this down. Let's pull this down a bit. Pull this down, dude. Like two maybe. And then I need like two more. Need like two more. Now notice here, I will adjust this one a little bit because this one should be loan payable short term, or the current portion of the loan payable. So notice in QuickBooks, once again, I'm going to have multiple, or whatever accounting software, I would like to have a separate account per loan. But when I pull them into my financials, I usually want just one account on the short term, one account on the long term portions. And therefore, again, you can kind of do that in QuickBooks or something like that, because you can make them sub-accounts, make a loan payable account, and then all of your loan payable sub-accounts that actually tie out to individual loans. For our purposes, I'm just going to add them both up and say this is going to be this plus this and just call it loan payable. Let's put an underline here, summing that up. If I double click, it's not pulling down to the bottom, so I'm going to say, hey, go down all the way to the bottom, dang it. And then I've got loan payable long-term, I'll say, and this is going to be the long-term portion of the loan, the part of the loan that is going to be extended beyond, that's going to be this one. I'm missing unearned revenue still. So that's going to be the part of the loan that's going beyond. So I've got to pull this whole thing down one more. I'm missing a current asset. So this one's going to be, I'll just say equal to unearned revenue. It's equal to unearned revenue. Rhymes. Isn't that cool? Let's make this blue and bordered. Right click, blue, and border that bad dog. Okay, then we'll put a double click here. We'll pull this down. So the sum is summing everything up. All right. So there we have it. All right. And then there's that one. So, okay. And then the equity, I'm just going to put all the blue in one equity account. So that includes the whole equity equals the sum of the entire equity from the balance sheet to income statement. It's all part of equity. Boom. It's going to put that in one number. I'm going to pull this one down so my totals line up. So there it is. We're in balance, baby. Okay, so that's good. And if they weren't in balance, I can check each one by just highlighting these and saying that's the current liabilities, 26,297. That's not right. What is happening? What is happening? 26,297. Yeah, I'm not in balance, idiot. That's what's happening. My stomach is growling. You're off by like 5,000. So on this, what did I do here? Que paso, entonces. This is this plus this, but this unearned revenue is wrong. Wrong. All right. It should be 450. So now if I select all of these, 26,294, and then 56,770, MUI B to the N, and then all of these, of course, tie out to the 143,720. All right, I'm in balance now. Okay, let's save it before I mess it. I don't want to lose what I've done. I'm going to hide now from HD, hide the HD. Don't worry, it'll still be pretty good high definition, even though we're hiding the HD. It still works, the HD definition still. So we're going to hide that. We're going to, where's the hide? There it is. Hide that. Now we're on the revenue. On the revenue side of things, that's down below here. So that's where the revenue starts. We've got the 3 revenue accounts. Boom, boom, boom. And then we'll just copy over equipment, rental, sales, service. Copy that down. Put an underline under it. And then we're going to pick up the cost of the goods that are sold, which I'm just calling COGS, which is not professional. That's not what you do on financial statements, but I'm going to abbreviate. And that, I don't want it to be negative numbers, so I'm going to flip the sign, making a negative of the negative, making it a positive, so that gross profit is a subtotal along the way of the revenue minus the cost of goods sold. It's gross profit. Gross. Your gross. I'm going to say then the other operating expenses are going to be the bank, all the rest of them. So I'm going to pull that down, pull it down, and it's probably, I probably need more room. I bet I added some accounts, but hold on a sec. Hold on a second. Hold on a cotton picking second. Why do I have to hold on a cotton picking second? Because I have a cotton picking problem. What's your cotton picking problem? I have an addiction to picking my cotton shirt, okay? I need a cotton picking second to deal with my cotton picking problem. Do you need more detail than that? Am I not being specific enough? Okay. To get on my case with my cotton picking problem. I've payroll expenses. I'm going to bring this down to utilities, and then these two I'm going to put into the other category. So I'm going to just pull these down. I'm going to select these and pull them down. And then we're going to drag this down, ba-boom, to utilities. That looks good. Let's pull this back up. Ba-boom. And then I'll select these. Is it going down to where it should? I'm going to pull this down a few more. Okay, so that gives us our total expenses for operating. Subtracting those two out, next subtotal along the road, 1,743. We put these other two into other income expenses because they're not like part of our normal operations. One's a financing situation that wouldn't be there if it wasn't for the fact that we needed financing, and the other is sale of an investment, which isn't part of our normal operations considering we're not an investment type company. Noting that in something like a QuickBooks, you could have two sections down here, other income, and then another section for other expenses, but sometimes it's easier to put the other income and expenses because that's going to make it a little bit easier on the eye. And I'd rather make the incomes positive and the expenses negative. I think that makes more sense. Let's change that. So I'm going to make the income positive and the expenses negative. So that's going to be, so the gain down here is positive, and then I'll keep the interest expense is going to be negative. So this time I am going to show a negative number because this category flips from both revenue and expenses. So the revenue is positive, the expenses are negative in this particular category. So other, let's say income, I'm going to say is positive and expenses are the negatives. So now you got more expenses than income because of the interest expense. And that brings us here. So we were here at the last subtotal along the way. This minus that gives us 2161. Is that what this adds up to? Let's select this whole thing. It should be 23. What in the world, dude? Equals the sum. Let's sum this up. Something's wrong. Something has gone horribly, horribly wrong. We need to do something. All right, we're off by 870. Sometimes you can take that and divide it by 2 and see where the issue is. Is this going? Yeah, this is going the long way. So the wrong way. See, so that's because I flipped the sign, but then I still didn't change my formula down here. So I'm going to say this shouldn't be this minus this. It should be this plus this because it's plus a negative number. And then boom, shock alaka. And we're back in balance, baby. All right, let's go back up. Now we just need, so now what have we done? We found a home for all of this. We found a home for all of these. But we haven't really found a home for these. We kind of did on the balance sheet, but we basically did all the thing on the balance sheet. We haven't broken them out into their own home. So that's going to be the statement of equity. Now remember, if you're using something like a QuickBooks or something, they don't usually have like a statement of equity. It isn't like a normal form that you often see because they kind of dump the equity accounts into the bottom of the balance sheet, putting net income in there, for example, which you can do if you have a very simple system or set of books. But if you have a complex equity section, one which has, for example, partners in it, or more complex corporate account, then you're going to need a statement of equity typically. And again, that's another reason why you could put this information into QuickBooks to give you a general formatting, but oftentimes you might need to, for more fancy formatting to be more professional, you might actually export it and do some formatting outside of QuickBooks. So for our case, we got the beginning equity, Beginning equity is going to be the equity at the beginning of the period, which is going to be the 77,896. This is the account that everything's going to roll into, which would be retained earnings if it's a corporation. The equity count for a sole proprietorship, it would be a partnership type of account, which we'd have to kind of adjust for the automatic rollover in a partnership, because there's going to be multiple partnership accounts in that case. Partnerships are actually kind of the most complex oftentimes to deal with. And then we're going to say that the change in equity, we had an let's put the draw, let's go in order. The draws, I'm going to say I'll keep them as negative again, because I'm just going to put both the increases and decreases for simplicity's sake in the same area. So that's going to be a decrease to equity. Investments, increase to equity. Now remember, when I think about draws, if it was a corporation, the draws wouldn't be draws, they would be dividends, right? And then the investments would be issuance of stock from the corporation. And then net income is going to be, I'm pulling it from the income statement right there, boom, and that should bring us to the ending equity of the 143,720. So this is summing this up. That's the change. 143,720, outer column. 143,720. Does that add up to what this whole thing is? 143,720. It does, dude. Dude, it does. Let's go from HB column to HL. Right click and unhide. Just double check our numbers. We've got balance sheet in balance. We've got net income tying out to what's on our trial balance, but we can also see that that net income is part of the statement of equity right here, and the ending statement of equity ties out to what's over here on the owner's equity. So it looks like everything is tying out like it should. Now, again, just for formatting's sake, just remember the statement of equity. If we put the adjusting entries back into QuickBooks, we might want to do that just to get the QuickBooks on the same page, but also make sure to do the reversing entries to not mess up the bookkeeping system. Or again, we might enter these adjusting entries into QuickBooks, but just remember a couple formatting items are going to be an issue if you generate the reports from QuickBooks. First of all, the name of the income statement is sometimes called the profit and loss, which oftentimes, like, you might want to call it an income statement for external reporting. Sometimes that might be more like formal, I guess. Sometimes, and then we saw the issue with the undeposited funds. If there's anything in there, we can have an issue with that. We might also, again, group certain accounts together that we like to break out when we do our bookkeeping. We also might name some of the accounts a little bit differently on our financials, such as not naming accounts like the actual Visa credit card or the actual loan, and putting like loan numbers in our bookkeeping system to help us to determine what loans are there. For example, we would want to combine those things together typically in one account that would just be loan payable. When we get to the financial statements, also, there's only a set way that we can do the sub accounts. Typically in some software like a QuickBooks, Xero has a little bit more flexibility, but is a little bit more complex. That comes along with more flexibility. So you have some different formatting that might happen with regards to, say, the furniture and fixture, with regards to how you want to be reporting the different categories and the book value and the accumulated depreciation of it. And same with the income statement. The QuickBooks or accounting software typically has a set format for like a longer format financial and possibly a smaller income statement. But you can have a lot of variations between like a single step income statement, which only has basically the income minus the expenses, versus a multiple step income statement that has multiple steps, along the way, multiple subtotals. You can adjust that a little bit in QuickBooks with the help and use of sub-accounts, and then selecting what type of report you want to generate. But you have a lot more flexibility with how you're going to format it, if you were to create your own financial statements, so that you can format them however you think is appropriate according to whatever format you're using, like generally accepted accounting principles. And again, the whole equity section is often not done the best in like a accounting software, especially like a QuickBooks or a Xero, because what they try to do is pull in and do the closing process automatically and then show you what's happening in the equity section of the balance sheet, which forces them to put net income into the balance sheet, which is weird if you need to allocate net income according to, say, a partnership agreement. If you have 5 different partners, you shouldn't see a net income. You shouldn't see really a net income anyways, unless you put the statement, the owner's equity statement, in the balance sheet. But it really doesn't work if you have a partnership where you're supposed to be allocating the net income to the different partnership accounts, right? So when you have a more complex equity section, then QuickBooks is trying to simplify things and do the closing process automatically and make the balance sheet show you how it ties out to the income statement, which messes up a need for a more complex statement of equity, which is another reason where, again, you might actually do the financial reporting, more formal reports outside of QuickBooks, possibly using like a QuickBooks as the starting point in order to construct the more complex reports. And of course, you can also do more formatting in other areas. If you use something just like an Excel and or a Word and kind of combine them together, you have the amount of formatting and customization you can do, adding notes and all that kind of stuff, of course, is infinite, whereas you are much more limited generating reports, even with the cool tools and templates that they have in accounting software typically. So just some general thoughts on that.